we discussed a very important content of the financial statements called the income statement. Income statement we discussed. I can have a quick recap that where the revenue come from. The revenue can be operating revenue or non-operating revenue. We had a lot of discussion about it. And then we also discussed about calculation of the cost of production, the cost of selling and distribution. Then we discussed various concepts of profits like operating profit. We talk about the profit before tax, and then the profit after tax. And in between, we talk about the finance cost and taxation and whatnot. So I think we had a very comprehensive discussion. Today, I want to go further and discuss a very important aspect of financial/managerial accounting called balance sheet. Balance sheet, I would say, is out of all the financial statements, balance sheet is the most important document. It shows what you own and what you owe. Simple. The definition is just a one-liner. Balance sheet is a reflection of what you own and what you owe. What you own is what you have the claim on others, and what you owe is what others have a claim upon you. My suppliers, I owe my money. I owe money to my suppliers. I haven't paid them yet. I show them as my liability. My customer haven't paid me yet. So now I own a claim on them. So it's my asset. And the simple benchmark of a company's good finance is that at no point of time your assets ever falling short of liabilities, i.e., that is, in other words, your assets, total assets, must be more than total liabilities at any point of time. Balance sheet also tells you something more. Balance sheet tells you a very important philosophical question. Does your company has the right to exist? Do you have the existential right? Yes, you have the existential right if your assets, sorry, I repeat, if your total assets are more than total liabilities. So in other words, what you wholesome own is more than what you wholesome owe. Look, own and owe, the difference is only N and E, but it changed the whole cycle. So what you own must be more than what you owe. And that proves a company is solvent or insolvent. So that proves the company's solvency. And if you can see here, the bottom equation, if assets are more than liabilities, then you are a solvent company. Solvent means you exist. You have the existential right. But if at any stage your assets are falling short of liabilities, then the company becomes what? Insolvent, which means the company doesn't exist anymore. And the difference between assets and liabilities is called the capital of the company. If it is a public company, listed company, then we call it share capital of the company. So you can see that the different words I wrote here. If your company assets are 1,000 and the liabilities are 700, so assets $1,000, liabilities can be $700. 1,000 minus 700 is plus 300. If the balance is positive plus, then the company is solvent, number one. And number two, the shareholders' capital is worth $300. And if it happens opposite, that the company's liabilities are 1,000 and the company's assets are 700, then the capital is negative. Don't ask me what is the value of the capital, because basically the company ends. It's the end of the story. It's not, it doesn't matter how bad. The question is that the company doesn't exist anymore. So therefore, it's very, very important the company's continuity, that the company remains solvent, which means assets must be more than liabilities. And then there are some synonyms I used. As I said, I promised you that you will learn various synonyms of the same term, in this course. Capital is also called shareholders' capital, or shareholders' equity, or equity capital, or net assets, or owner's capital, or even shareholders' net worth. So these are the different words which you may come across. So it's very important that you must understand. You don't have to memorize on a daily basis, but as long as you are able to understand these words, basic idea, and as long as you can identify these words in your case companies, when you see your real case company and you can identify these phrases or words, that's fine. Okay, I don't want you to learn the definitions of these words as long as you're aware of them. Before I go anywhere, before I explain these terms, I want to show you something. I think that will help you to understand the company's finances better. Let me draw a picture. There's something in the chat. Yeah, I think you asked me a question. Why we take the non-financial company is a bit off track, but I can explain it to you again. The financial companies are under strict regulation of the state. On the other hand, the non-financial companies are more liberal, they enjoy more freedom. The regulatory hammer falls more often on the financial companies, even though they are the private financial companies. Because the nature of the finance is so strategic. I'll tell you something. If tomorrow a retail company becomes bankrupt, there would be hue and cry for a few days, and after some days, people would forget. But if tomorrow a bank fails, you see what happens? There would be a massive panic. What happens if a retail company becomes bankrupt? Okay, you can find the eggs and potatoes from some other shop. But if a bank fails, there will be a run on money. People would be going to the bank and withdrawing the money, even from those healthy banks, the banks which are doing very good job. There'll be an extreme panic. There'll be extreme, it's like a big crowd and there are some snakes and you don't know what to do. So everybody's rushing, jostling, so there'll be absolute mayhem in the society if one bank fails. So that is why the banks or the financial companies, their nature is so strategic that the state doesn't want anything wrong happens and then react. State is rather more proactive and making sure that this bad situation does not arise in the first place. So this is why the financial organizations, even though many of them can be owned by the private bodies, they are highly, they have to disclose so many things. They have to comply with so many regulations laid down by the state. So that is why I thought that it's not a fair comparison. A company where the board of directors can take any decision And then a company where the board of directors have to make a huge checklist. This is do, this is don't, this is do, this is don't. That will make some unfair comparison. So that's why I thought that maybe we only focus on the non-financial companies. Yes, Zara. Financial institute. After a while, they bankrupt, and all people lose their money, and they're upset because they lose their money, and then something. Yeah, that's true. Yeah. I think the bank is the life and blood of the finance. Is a kind of blood in the body, and if there is a too much blood flowing or too fast blowing or too slow, moving, that can cause a lot of problem with the health. So yes, it can be dangerous. you have to handle it with care. Yeah, and not only the finance in the whole society, but even at the company level. You can be a fantastic producer of some software products, but if your finances are in the bad shape, if you don't know that your liability are picking up and they're almost touching your assets, you can invite trouble. I can give you so many examples of the bankrupt companies in the recent history. And I can assure you that on 95% minimum times, they became bankrupt purely because of their financial mishandling. Till the last breath, till these companies died, they had fantastic buildings, fantastic machinery, excellent engineers. The designers were state-of-the-art people. I mean, everything operational, everything was going on well. Everybody was happy. Those lovely ladies, gentlemen wearing nice ties and speaking chaste English, everything was great. But then something was rotting, and that was the financial bungling going on, something wrong happening with finances, until it was too late to resolve it. I mean, who can forget the Enron company? For any engineer, any mechanical and any energy, those petrochemical engineer, Enron was a dream job. Everybody was longing, every engineer was longing to work for Enron. And the company was so great, so much well-connected. But what happened? Bad finance, and the company disappeared. And you know how long it took for this company to disappear from the scene? Less than a week. In less than a week, 1 week, less than a week, the company disappeared. Bad finance. So this is why it's even for the non-financial companies, the corporate finance is very important. So I have no hesitation in saying that in many companies, CFO is more important than CEO. Because he's the guy who would release the money, and he's the guy, if something wrong happened, if CI has, not CI, if CEO has somebody to shout at and somebody to blame, then it's CFO. The CFO is a very important person. So yeah. So this is the reason I was preferring not to include financial companies in the discussion. So, but coming back to the real point, which I was planning to discuss, this was a positive distraction. I always welcome them. But before I explain you more terminology about the balance sheet, I want to draw your attention to this whiteboard. If you ask me, what is a company? And if I can explain the company without speaking a sentence, single sentence, I can say, yes, I can try. To me, this is the company. Now, what is this? Well, this is the liabilities side. Sorry, I try to liability or liabilities rather. Liabilities are where money comes from. For example, the company borrows money from the bank. When you borrow the money, is it a liability? It is. You owe money to the bank. But then you can also say that the money comes from. So basically, liabilities shows your financing side. So liability can also be called as a financing. This side is assets. Assets, basically, if I say money comes from, I can say assets, money go to. Money goes to. Give me an example of asset of a company. Let's say you make furniture. What will be your asset? If you are a furniture manufacturing company, what can be your asset? Equipment. You pay money and you buy equipment, and equipment is your. And how do you acquire this asset? Because money go out of your pocket. When you buy something, you buy a t-shirt, you buy a pair of shoes, it's your asset. But then money goes away from your pocket. And this is called investment or investing. So if somebody asks you, hey guys, I came to know that you study finance. What is the difference between financing and investing? Well, financing is money comes from, investing is money goes out. And the question is, financing has a cost. Do you agree with me? Financing doesn't come free of cost. Finance is no free lunches. There's a cost. And imagine the cost of overall financing is 4%. Now, this 4%, the cost of financing, put a hurdle. Have you seen the high jump in athletics? High jump shows you the bar above which you must jump, otherwise you disqualify. So therefore, the 4% cost of financing set a bar on asset that, you know what, you must use your assets so much, so well, that your return on assets is more than 4%. If I buy a machine and I'm making furniture, and machine is actually, I finance through a bank. And the bank is charging me 4% rate of interest. Now machine comes, what do I do with the machine now? I work. So it means that I must work so efficiently that I don't make any wastage. I use machine properly. I have a proper upkeep of machine, that the return which I generate on the usage of my machine is more than 4%. So I have a bar, 4%. If this cost of borrowing, if this cost of financing is 5%, then there's a more pressure on me because the bar is raised high. Like in athletics, in high jump, you jump in the first round, maybe 1 meter, then they raise the bar to 1.25 meters, and so on and so forth. And then finally, you win or you lose. Now, I use some words: clean the machine, use the machine properly, no idle hours, machine is well maintained. That is called third pillar, called operations. Operations. How well I use my machine on daily basis is my operations. An income statement, which we have done last week, is basically showing how well your operations are conducted. Can you see this middle rectangle signifying the income statement, your operational performance? Raw material is not wasted, labor hours are not wasted. If you have some oil, it's not depleted. You make proper use of it. These all are your operational. So the income statement highlights your operational efficiencies or inefficiencies. But when the money comes in and the money goes out, that primarily is shown by the two sides of the balance sheet. One is assets and the other is liabilities. If you make good use of assets with the better operations, then your profit will increase. And that profit you can recycle towards more R&D and buying more assets. And if your operations are not going well, you are wasting a lot of resources, the labor is idle, machine breakdown, or you don't even update your machinery, then what will happen? Then you will have losses. And losses is basically erosion of your assets. Your asset base goes down. On the contrary, you have to borrow more money from the banks and the others, so your liabilities will go up. So it's not a very healthy situation. So that way, the income statement and balance sheet are both these things are in sync together. So, any question about this? So financing, investing. Financing, money comes from, in other words, liabilities. Assets, money goes out. The return on assets must be more than the cost of liabilities. And this thing can only be ensured if you are making good behavior on daily basis. In other words, operations. If you do well, the whole staff is having same lunch hours, lights are on, machines are still running, nobody took care of the raw material, it's rotting, the electricity bill is increasing. Suddenly there's an overcrowding of staff that nobody can even work properly. And sometimes there are some hours when the machines are idle, nobody's working. There's no discipline. There's no accountability. How much inventory was released in the morning and how much inventory is back in the store in the evening. So all sort of indiscipline, all sort of poor management on day-to-day basis is going on. Obviously, the company's operational performance will be bad. Losses, hole in the assets, rise in the liabilities. And it won't be too long. It won't take too much time before you reach a situation when your assets are falling short of liabilities, and thus the company disappears. On the other hand, there's a well-managed internal control system. There is a proper vertical and horizontal layers of management. There's a factory workers, supervisor, floor managers, and there is a system of reporting and disclosures. Everything is noticed. The data that is well maintained. People who are the engineer or the floor manager, they have done the work in such a manner that it's not too many people on a given time and too less people in the next hour. Well managed, discipline, control, accountability, management, all these phrases that you hear in the books, in the textbooks, they really exist. Company's operational performance goes up, the company's profits goes up, thus there is a further addition in the assets. This is how the companies grow. So therefore, the operational performance, this part is utmost strategic. You can borrow the money at the cheapest rate of interest. You can buy the best of assets at the low price, but if you don't use them properly, it's a bad management. So operations are key to the success. Any questions about this picture? I apologize for my cacography. Do you know the word cacography? I explained it once to you. You know that cacography? You don't know about cacography? Do you know calligraphy? What is calligraphy? Sorry? Fancy writing. Cacography is also fancy writing, but in a different sense, as you can read. But I hope you can read it, something, yeah? That makes sense. That's good. All right. Okay, now you know the assets. I will not spend too much time. Assets are what you own. Assets are where the resource is going to. The assets could be of various types. The assets could be tangible, like I mentioned, plant, machinery, furniture, fittings, land and building, all these vehicles and the computers, the fixed ones. So that's the tangible things, and tangible are physical assets. We discussed about it. And then we have the intangible assets like goodwill, patents, trademarks, softwares, even your brand equity, intellectual property. So all these things which are non-existent physically, but they are very vital. Your human resources, your intellectual capital. Imagine that two companies, they have the same value and same quality of physical assets, tangible assets, but one has set of managers and engineers who are more qualified, more experienced than the other one. Then the brand equity in the form of this high valued intellectual property of one company is superior than the other. Intangible assets. I hope you understand the concept, right? So all these ideas, all these thoughts which have the value, they are called intangible assets, which don't have any physical property, but they are absolutely strategic. And there are some companies in the world whose 90% or more of assets are basically intangible. Look at some company in the business of entertainment like Netflix, or some IT like Microsoft, or some research and development company. They would be having a whopping amount of assets in the form of intangible form. In fact, most of the growth companies who we call as growth companies, the growing, fast growing companies, they have more of the intangible assets. On the other hand, the old economy companies, traditional companies like furniture, cement, engineering, transport, shipbuilding, heavy machinery, then they would be having more of the tangible assets. Of course, they would be having intangible assets also, but the question is the relative share of both. The assets can be current and non-current. I'm not sure if I explained it to you before or not, but if not, there's no problem. The current assets, by definition, it's very, now this is some technical thing here. By definition, the current assets are those assets which mature or whose life is less than a year, which means those assets whose life is maximum 364 days. That is called a current asset. I want to give you an example, even though you'll see so many examples, but I want to give you one example here. I have sold some goods to you. You haven't paid me. You said that you will pay me later. I sold goods to you. Should I treat you as my asset or as my liability in my books? Sorry? Asset or liability? No. I sold goods to you. You are my buyer, but you haven't paid me. You said you will pay me, let's say on 364th day. Are you my asset or liability? No. I repeat, listen carefully, listen carefully. I sold something to you. You owe me money. If you owe me something, it means I own a claim on you. Now, are you in my books, should I show you as my asset or liability? Okay. Simple, asset or liability? Asset.
It's asset.
And what is the day when you will pay me? I will treat you as my current asset. Why? You are my asset. I own a claim on you. But the fact that you will not pay me on 365th day, you will pay me on 364th day maximum. And the definition of the current period and non-current period in finance and accounting is that anything which is lasting up to 364th day is a current period, is included in the current period, and anything up to 365th day and onwards, it could be 20 years, it could be 50 years. But the starting point is 365th day. Anything up from 365 days and above is called long period, or we also call it non-current period. That is a simple definition of current and non-current. You can call it short period and long period, but I think these words are more used in economics. In accounting and finance, we use the phrase current and non-current. This is a little bit abstract definition, because if you pay me on 365th day, yeah, and the other customer pay me after 20th year, they both are in the non-current period. Am I making it easier or confusing you? But first of all, tell me, do you understand the meaning of current and non-current? The current is maximum 364th day. And the non-current start from 365th day up to anything. Look at the governments, for example. The many governments, they borrow from IMF for 20 years. They can borrow for 1.5 years, and they can also borrow for 20 years. Both are in the non-current period. Sorry, what's your point now?
You consider it your liabilities already as a company.
Sorry, you pay me after 400 years?
Yeah.
I 400 years, sorry, 400 days. No. Simple definition is that if when I sold goods to you, right? The commitment, the agreement is that you will pay me on 400th day, right? I will only add in my current assets because that is what we agreed. But I can also show that these assets, look, when I make an agreement with you today, I have to record it today. I don't know whether you will pay after 400 days, right? Now, if you pay after 400 days, then after 364 days, I would still keep you in my current assets, rolling current assets, because that's what we committed, right?
As a company, if you finance your operation, like you said, you have borrowed money from the bank. Liabilities there. You consider also your foreign asset, which is not paid with the agreement of the particular days, as your liabilities also the bank.
Of course, if, for example, most of my sales is on credit basis, and there is some problem in the market that all my customers are calling me that they can't pay me. There is a severe financial crunch in the market. Now, if I don't get money from you guys, how would I pay to then I have to renegotiate with my lenders also. It could be possible that when I sold goods to you, the agreement was that you will pay me in 3 months' time, 90th day. And I also made an agreement with the bank that they would give me credit for, let's say, 120 days. I always keep 1 month buffer, right? So 4-month credit the bank gives to me, 3 months credit I give to you. But then it happened that you and other people, that they're not going to pay me. If they don't pay me, how would I pay to my banker? Then I have to renegotiate with the bank. And guess what? If all customers of the banks are coming to the bank, that bank manager, can you give us more extension? And it happens to one branch, one bank, it can be a big banking crisis in the country. This is why the banks, the central bank, are very proactive. Whenever they see some problem, they just come in the market immediately, right? So this shows how well the banks should be prepared. Not only banks, but the head of the banks. Who is that? The central bank of the country. And then above that, because Finland is a part of the European Union, then we also have the European Central Bank, which is even more worried that the depression or the problem in one country, it should not be an infection to the other country. So they don't want that this problem become contagious and the problem in one country transmits to the other country. So this is why the role of bankers is very important in this field. You're right, it can be a big problem. Yeah, good question.
So what is going now? Will you still be current assets since you're not paying with increases by this?
Sorry, what's going on about? Yeah.
What will you be
Yeah. Yeah. I understand. Yeah, it will be classified still as a current asset because I have no reason to believe that he will still not pay me. But just imagine that on 400th day, he says that, no, I can't pay you again. Maybe I have to renegotiate the whole contract with him. It could be possible that he is my well-trusted customer. We've been in touch, and I know that this guy is going through serious issues and he will not pay me for next 2 years, let's say, just say one-off example, if it's not everybody, but just one-off. Then I can give him repayment, we use a phrase called moratorium. When I give you some time when you don't pay anything. So, and if this extension in the repayment is more than a year, then I would transfer him his account from my current assets to my non-current assets. And obviously, longer the credit I give him, it's possible that I don't charge, because I think in the normal business practices, if you are paying on 90th day, there's no interest involved. It's a normal, usual business practice. But if the repayment period becoming longer, not just longer, but there is a breach of contract. Look, I can sell you my product for even 6 months credit with no interest. Because I like you. I know that you are my customer. We do business dealings very often. The interest rate will be involved, I think, more prominently if there's a breach of contract. Then I would be imposing some, we use the word penal interest rate, like a penalty thing that you have to pay interest. I will only give you credit extension. I will only give you the credit extension if you pay me now 2% rate of interest. Otherwise, I'll sue you. So I think these are the different things which can happen. Various outcomes can come out of it. I can treat the situation nicely, or I can treat this situation harshly in the first instance when he doesn't pay me on 200th day, which he promised to me. In the business dealings, these things happen on very personalized basis. If my very big customer is doing this thing, I can't be too harsh, because if I lose him, if I lose this big customer, it can be, a big problem. A bigger problem than what I am confronting with his non-payment of the bill now. Then I would absolutely lose him. Because it could be a temporary problem with him. But once things settle down, he will remember, oh, this, I used to think that this guy is nice. He will understand my problem, and he would treat me in more nicer way, sympathetic way, but he was too harsh, sending me a reminder, threatening me. Okay, I no longer buy things from him. I go and buy from somebody else. So all these things you have to, it's not just about numbers. You have to think from the other, prospects, qualitative prospects also. See? Right, the current and the non-current. And then we also have the fixed assets and the non-fixed assets. Fixed assets are those, I think those which are the land, building, are the typical fixed assets. Machineries are fixed assets. The vehicles are the fixed assets. The non-fixed assets, which are like raw material, can be one example of the non-fixed assets. The other is you have those, those spare parts, those equipment, inventory, those kind of things could be, as we use them, they can be called as fixed asset, whatever. No big deal. Some examples of current assets are given. The definition is given here, the cash value within 12 months. I would say that 12 months, you may be confused with 365th day. It's not 365th day is excluded from the definition of current assets. So before the 365th day starts, the current period is over. Yeah. And the current assets, some examples are given. Cash is the most current, then there are some cash equivalents. Cash equivalents. What could be cash equivalents? Any idea? Sorry? Yeah, that's a good example. You are in Finland, of course, cash is euro, but then you also make some sale to Australia, and maybe they paid you in cash, and you have some cash in the cash form, some Australian dollars, right? And you need money, okay? You can just go to the currency shop or the bank, and you can exchange them with euros, yeah. That's cash equivalence, yeah. Gold is also cash equivalence, yeah. You can easily sell. Sorry, the promissory notes, yeah. Promissory notes are very interesting. Any idea what is promissory notes? Huh? Yeah, something like check here.
With some papers to pay back in 1 day or maybe during coverage.
Yeah.
And then it's possible to change with another people in a business.
Yes.
And they accept these papers. Yes.
Good. Yeah. Very interesting. Promissory notes. Anybody, you have any idea when you hear the word
Hello.
promissory, does some similar,
Hello.
some familiar word comes to your mind?
Hello.
Promissory. Can you identify the root word here? Promissory note.
Hello.
Can I give you any hint? It's a promise.
Hello.
It's a promise. Look, it's
Hello.
very important that you raised very important point, this promissory note, but then there are also used the word accounts receivables. Look, it's very important that you pay attention and listen the difference between the accounts receivable and accounts promissory notes. They are same, but different. But the end effect is same. Wait a sec. I sold goods to you. And you say you pay me in 90th day, 90 days. No problem. I draw a bill. I send an invoice to you. You sign it, and the copy of invoice comes to me. Who drew the bill? The seller, me. You signed, you accepted, the bill comes to me. That is called trade receivables. Trade receivable is the one, is that document which is prepared by the one who owned the money. Now, if I'm in need of money, my commitment with you is that I will not bother you. You will not pay me before 90th day. I need money tomorrow. We signed the agreement today, but I need money tomorrow. I can transfer that bill to the bank. The bank will discount and they send the remaining money to me. Okay? And this money, I make use of my circumstances. I deal with the situation. On 90th day, you make a payment to me and I pay back to the bank. Simple. Everybody happy. I'm happy because I didn't have any liquidity problem. You remember the liquidity problem? The current obligation, I meet very well. You happy because I didn't bother you. And bank happy because bank is able to transfer money without any hit. In fact, bank earned income on this transaction. You know, the bank gave you the charge service cost, service charges, right? This was the trade receivables, right? Here the seller draw the bill on the buyer. Look at the promissory note. I sold goods to you again on credit, right? And I'm saying, you know what? Look, you've been this time I'm showing some kind of lack of interest in giving you any credit. And you are really pleading that, you know what, no, I think give me 90 days, I'll pay you. And guess what? This time you draw the bill on me. So the buyer is drawing a bill on the seller and writing commitment, promise that I promise that I would pay you on 60th day, let's say. Again, the bill comes to me. Again, I need money. I can send the bill to the bank. Bank gives me money. You make me payment on 60th day, end of the story. But there's a difference. In the trade receivables, or the bills receivable as we call it, it's the seller who draws the bill and the buyer accepts it. In the promissory note, it is the buyer who draws the bill and seller accepts it. So that's the difference between trade receivables and the promissory notes. So otherwise they're same. Cash equivalents are, as you said, gold and the foreign exchange. That's fine, absolutely. There can be some more cash equivalent. The definition of cash equivalents is that those assets which are not really cash, but you can convert them to cash without any problem. If I have the T-bills, the bills issued by Bank of Finland, I invested in those bills issued by the Bank of Finland, I can easily just go and sell without any problem. They're so popular, they're so well known. So it's not really cash, but it's almost cash. Almost cash. You see my point? So those securities which have this element of convertibility to the hard cash, they are called cash equivalents. Yep. Well, they are nearly cash. They're almost cash, you know, or there's cryptos, for example. It depends upon like acceptability. I think the crypto is a little bit different animal. Its acceptance is very, it's not really a regulated currency yet. But there is a one more phrase, I don't know if you have heard or not, it's called CBDC, Central Bank's Digital Currency. It's not really cryptocurrency, issued by some unknown entity to finance some very strange activities. And nobody knows where the money comes from and who's the ultimate owner. But in CBDC, the central banks are issuing the digitalized currency, which is more legal and more accepted. Yes, then it's a cash, because it's just a cash. Sorry, yeah. Sorry?
Post-dated check.
You mean the check?
Yeah, that's post-dated.
Yes, the post-dated check, yeah. Yes, basically, yes, yeah. That is also in the category, yeah. And then we have some prepaid expenses. It's like, for example, the prepaid expense, I think I gave you example that this is the month of January. And let's say you are traveling somewhere in March, long time, yeah? And what you do, you make, you not only pay for February rent, but you also pay for the March rent. Then the March rent which you have paid is your current asset, because it's your claim on the landlord, on the owner, you know, because you paid extra money, it's a prepaid. So that could be also an element of current asset. Why we call it current asset? Because it's prepaid for 1 month, and 1 month is less than a year. Hence, it's a current asset. And there can be some other liquid assets. There is a huge list of that, but the philosophy, the nature is same, that the periodicity is up to 364th day, right? And yeah. Inventory is also the current asset. Why? Because normally you convert the inventory to you process the inventory in a year. I know in some companies, you have the inventory which stays in your store for a long time, for a year or so or more. But usually we expect that the inventory would be converted would be processed basically under a year. And then all other assets could be non-current assets like machinery, building, equipment, so on, so forth. And the liabilities, as I said before, the resources coming from liabilities shows your financing side. The asset shows your investing side. I think we agreed about it. And similarly, the liabilities can also be the current and the non-current. If I buy something from my supplier and I promise to pay him on 90th day, that would be called my current liability, because this liability would mature under 364 days. So basically, it doesn't really differ. Yeah. And then we also have the non-current liabilities. If you owe something for over a year, then it's a non-current liability. Very quickly, I want to show you the example of this is something which you must watch, must pay attention to. This is the balance sheet of British Petroleum. If you want, I can show in the form of the slide, because then it'll be easy. Maybe. Yeah, here we go. So you can see here, all I said before was that these are the company's assets. Pay some attention to these assets. The broad category is that there are current assets and the non-current assets. And then we club them together, they become current assets. And you can see that there is a 2 years data. So there is a horizontal comparison between two years. And there is, because BP used lots of tangible assets, the fixed assets. So they have some category of fixed assets also, but otherwise, we often have two categories of assets, the current and the non-current. My suggestion is that pay some attention to these different items and get some idea that what these assets mean or what they may mean. But the big disclaimer in the bold letter is that not all the companies have the same assets. Okay, so for example, if it is a BP, I would say Shell, Total, these kind of oil company or the engineering companies, they might have some similarities. But if you are talking about some IT company, they might have some different items. So don't say that this is not a textbook example. This is a real company example. Okay, and the nature of assets can vary from company to company, but the definition is still valid, that we have two types, two categories of assets, the current and the non-current. The current are those claim on others which should mature before 12 months. And the non-current are those which go beyond 12 months. So please go through these items. And if you find something interesting or something confusing, then please let me know. Okay. We can take a pause from recording, Seher, yeah? So let's say there are two companies next door to each other. They have the same quantity of assets, same quality of assets, physical assets, right? But one company has much better manpower in the form of human resources like engineer, architects, managers than the other. then this extra value, which this better company has, is called goodwill. So they would add some additional value to their market price. It's called goodwill. Goodwill is also one form of goodwill is that if you are a company which is having history, you have a brand name, people know you, and now you want to sell it. The buyer would pay you more than the real value, and because you have been in the business for a long time. So when a new buyer takes over you, he's not only taking over the physical assets, but he's also taking over your reputation. That is goodwill. Okay? That can be the goodwill. Yes. It cannot be 100 times the physical value of the assets. Accounting rule allows that how much the goodwill you can create. Even though these accounting laws, they're not really laws, they are more like guidelines rather. Even IFRS have some certain guidelines. I don't remember exact percentage, but I read long time ago that the value of the goodwill cannot be more than 10% of your book value of assets in certain cases. But there are a lot of loopholes. The percentage of goodwill is different for the companies which are growth companies, like intangible sector, asset based. And similarly, there are some different exceptions for the tangible asset based company. But there's certain fixed percentage which you can generate through the goodwill. It depends upon many factors, not just the human power you have, not because of the age. It also depends upon the location of the company. If your location is very prime located, then you take some extra. So all those things, look, it's basically all those points which give you an edge over the others. That adds to your goodwill. And I tell you, it's not a very easy, it's a very gray area. Goodwill is a very, very gray area. Because the accountants of the company have a lot of leeway over the creation of goodwill, still, despite the laws being very strict. Anything you see interesting here? Explain it in a very simple way. I hope it's a simple way. Sir, you need to record a little bit, yeah. Derivative financial instruments can be defined in the most complicated manner you can ever imagine, right? But in a nutshell, it's like buying a financial insurance. Buying a financial insurance. When you buy car insurance, it's your asset. When you buy the car insurance, it's an asset. You know why? Because in the event of this contingency, any emergency, the insurance company owes you the money. So you own a claim on the insurance company. When you pay the insurance policy fee and the premium, that's your asset. So basically, insurance is your asset against some claim against any problem happens. Now, derivatives are like financial insurance claim. I'll give you an example. And I think you need to write it down, or you need to understand this very carefully. You are a Uvascular-based little company, tiny mini. You have bought some important machinery from a Canadian supplier. And the cost of this machinery is, this figure you can write down somewhere to remember it. The cost of this machinery is, let's say, 200,000 Canadian dollars. So I repeat, you are a small Uvascular-based company. You need some technology or machinery, you buy from Canadian supplier, and the price or the cost of this machinery is 200,000 Canadian dollars. And the deal is that you will make a payment in 3 months' time, and you will pay in Canadian dollars. You pay in 3 months' time, and you pay in what? Canadian dollars. So let me explain it to you. Let me share this example with you with the whiteboard. So I repeat, maybe text, yeah. So here is a Uvascular based company. Buying machinery worth Canadian dollar 200,000. Payment due on, what date is today? Today is 30th of January. So February, March, April. So on 30th April, the payment is due. Tell me something. And let's say today, remember the deal is that you will pay in euros or Canadian dollars. How would you pay? You pay in Canadian dollars, okay? So today, 1 CAD is equal to euro 0.75, let's say. But you don't need this, huh? Sorry, say again. I'm not sharing it. Oh, my apologies. Sorry. Share screen. New share. Oh yeah, because I know what the problem is, because if you have this how do I exit? Escape? Yes. Yeah. So now I share my screen once again. I'm sorry for this. I didn't look behind. And this is the new share whiteboard. Can you see it now? So you are a Uvascular based company. You're buying machinery worth 200,000 Canadian dollars. The payment is due on 31st of April. And today, the exchange rate today is 30th of January, 2023. This is the rate of exchange today. Can you visualize some risk you are facing here? Can you see anything which can make your sleeps, which can give you sleepless nights, or which can really worry you, here? Think. I want to give you 1 minute. Think, all of you. I want to hear multiple responses from you. That what do you think can be really make your life difficult? This situation equal to 150,000 euros on today's date. But you know what? We can't make payment to our supplier instantly. This 3-month period is good for us because it makes us more time. We can buy more time. But there is a problem, which you said. The problem is that if we are not prepared, and we just have this kind of this lazy, kind of this laid back type of attitude, reactive rather than proactive. It could be possible that on 23rd April, 30th April, if one CAD is equal to 1.20 euros, Canadian dollar appreciates or euro depreciates, look how much you have to pay. You may have to pay 240,000 euros. Look, nothing is wrong with your machinery. Nothing is wrong with your managers. Everything is good, great workers. But there's one bad thing, that you were so unaware of the financial fluctuations. That when you look, the Canadian company doesn't know about your problem. They would demand 200,000 Canadian dollars from you. The question is that at what price you arrange these Canadian dollars. You go to bank, to get 200,000 Canadian dollars, you have to pay 240,000 euros. And this happens on 30th. This may happen on 30th April. As a good manager, you will never let this situation happen. So you sign a contract. You sign, now you see, now we talk about derivatives. Okay, I write down derivative. How you will do with derivative? When do you sign this contract with the Canadian company? You sign it today, 30th of January. You sign this contract. And what do you do with that? You go call the manager of Nordea. Say, Mr. Manager or Miss Manager, I want to meet you. You send your CFA and they negotiate. And they say, I'm making it over dramatized, but I think it's very important that you understand it. I need 200,000 Canadian dollars, not today, but on 30th of April. Can you offer me any price today? Even though I need them on 30th of April, but can you offer me some price of Canadian dollar today so that we make a deal right now? So that my future remains less painful, so that I don't have to read the rates all the time and sometimes feeling very happy, sometimes feeling very sad. I don't want to go through this mental trauma. And then the manager says, all right, I can offer you one rate. And remember, this conversation is taking place today on 30th of January, okay? And the deal, let's say the bank manager offer you a rate and he says, you know what, I can offer you a Canadian dollar. Let's make a deal today that I would charge on 30th of April, I would charge, let's say 0.79 euros. And this I would, okay? And you think that, you know what, the Canadian dollar has been showing an upward trend. It can go beyond 0.79. It's not a bad bargain. And you say, all right, Huva, let's go for it. Let's sign a contract. So now you sign a contract that whatever is the market price of Canadian dollar on 30th of April, you will only pay 79 cents for 1 Canadian dollar. It's like buying an insurance. Now you know for sure that when 30th of April comes, you have to pay, multiply 0.79 with 200,000. So you know for sure that on 30th of April, your fixed payment is 158,000. Yeah. And just imagine that you check out of curiosity on 30th of April, what was the exchange rate? and this was the exchange rate, you will feel so happy about yourself that you made a very good decision. You know, it's like insurance. It's like buying an insurance. This whole transaction is called basically financial derivative. I will not go too much into it because then it's a different topic altogether. But this much I can tell you that financial derivatives are basically buying a financial insurance. Yep. But do you understand the concept? It saves you from the market fluctuation which occur on daily basis rather on minute-to-minute basis. So you strike a deal with the bank that whatever is the exchange rate in the market, we don't care. The bank make a commitment with the company that whatever is the exchange rate on 30th of April, regardless of that, I would pay you. I would sell $1 Canadian to you, the company, for 79 European cents. And the deal is done. So now it's fine. You don't care about what happens in the market. Market can go in, the dollar can jump, dollar can fall, whatever situation. At least you bought some peace of mind for yourself. Remember, you are a small company. Imagine companies like Coke, Pepsi, who are dealing with hundreds of currencies because they have presence almost every country in the world. If they don't buy financial insurance, they would have become bankrupt by now, for sure. So this is called derivative. If you make this deal for less than a year, then it's a current asset. If this deal is for more than a year, it's a non-current asset. Can you see here in this example, the Uvascula-based company need to pay in 3 months, then it's a current asset because it's less than a year. But imagine you are BP and you are dealing, you are going to buy something from Saudi Arabia, the crude oil, and the payment will last 5 years. You do the same thing with your bank, but then it will be called as a non-current asset because the duration is more than a year, okay? So you need to know. So this is the main dynamic of the financial derivatives. Does it make sense? In other words, this is nothing but the insurance policy. Policy against what? Policy against market fluctuations. Yes, your point?
I have to ask you, because I didn't know about the bank will make the contract.
Oh, yes.
Okay.
They do.
But
you know, we have a section called corporate banking. So this is part of corporate banking.
you lost for a bank. The rate is going to be fluctuated.
No. I understand your apprehension. I understand your apprehension. Because the bank could have sold a Canadian dollar. Just imagine that on 30th of April, the market rate of exchange is 120, right? Bank could have sold it for more price, right? So in this case, there's one gainer and the other is loser. Look, in this policy, it's like you can also say about the insurance policy as well, isn't it? Like the car insurance. You can say that, hey, why I'm paying car premium every year? I haven't met any accident for the last 5 years. So every year, look, see them. You see my point? You pay car insurance premium. The company is becoming richer. You are paying premium every year. And don't you think, why I'm paying it? But then on the other hand, if there's a loss, then it's you have, you get a lot of money. Then the loss goes to the insurance company side. And I tell you something, in this case, maybe you bought one contract from the bank, right? The bank is selling many contracts. And you're right, in some contracts, bank can have loss, but then bank can have gain from the others. So that even out. Yeah, it's a business. Look, when you go to the Prisma or Lidl, right? Do you think that every product is on the shelf, Prisma is making money? No. There are some products on which Prisma make loss knowingly. But then Prisma can raise the price of the other products. Because if you don't offer the loss-making product on the shelf, then the customer don't find the product, they get angry, then they go to Lidl or S Market. Then in the future, they will first go to S Market before they come to you. Does the bell ring? So that is why you have to go through this process. Yes.
If I want to buy this thing from Canada, so there are somebody say the transfer.
Precisely.
So
Yeah.
Exactly, but it will be something.
Oh yeah, there is a fire insurance, there's a theft insurance. Even nowadays, we have the environment insurance. We have the environmental derivatives also. You know, there's a risk. Something is coming from southern coast of USA in ship. There can be some cyclones, there can be some problems, the ship can sink, all the products can go, you know. Because the cost is involved, you own a claim, right? So because if you own a claim on the bank, then it's your asset. See your point? Yeah. So see the simple rule of thumb to understand the balance sheet is that if you own a claim, call it asset. If you owe a claim, call it liability. Simple. Like in life, we have the good deeds and the bad deeds, isn't? All the good deeds are assets, all the bad deeds are liability. And we expect that at the end of our life, the sum of our good deeds should be more than some of the bad deeds. You see what? Sorry, I'm getting more philosophical. But this is all about the owning a claim or owing a claim, yeah? Okay, so thank you very much.